I want to start off by heading to Jimmy Lee. He's joining us at the top of the show here. He's the founder and CEO of the Wealth Consulting Group. So, Jimmy, it's a pretty quiet Monday after last week's trade drama, but we have a bunch of Fed speakers that are lined up. We've got a little bit of data coming our way. What drives this market if we don't get a bunch of headlines on the trade front?
I think it's going to be about the consumer now. And so, again, the stock market's going to go up and down and teeter based on the news du jour of the day regarding trade and where we've gone. And where we'll go here in the next couple of months. Right now, I think the consumer is holding this economy up, and we need to get a trade deal so that business confidence returns and we can get spending again in corporate America.
I think this is really important because it's really been kind of that, basically the pillar, right? As some of our manufacturing data has been slowing down, it's been the consumer. We had a pretty decent sentiment number on Friday. So, Jimmy, do we basically assume that's kind of the backstop for things to not get too rough in the economy as long as those numbers come in? Retail sales on Wednesday looks good.
I think that's very important, especially right now. Again, I think we're in a very, very sensitive time, Oliver, for the economy in relation to whether we tip over or not. And so we need to get some good news on trade, which I suspected we were going to get something prior to year end or soon thereafter, because we can't have another quarter go by with bad data. I think it'll be too much to try to overcome at that point for the White House in terms of re-election. And so we need to get a trade deal. And I think the consumer, last week's report was pretty strong, a surprise on the upside on the Michigan consumer sentiment numbers. And on Friday, what was interesting, you've been talking about value stocks, Oliver. On Friday, when the market shot up, value stocks actually ended up outperforming growth on Friday. We're getting this rotation into defensive sectors.
I think it's a crucial point, Jimmy. When you talk with clients right now, how is sort of the sentiment in terms of your ability to kind of gauge where people are taking risk and to what degree? We know that as the data here was getting pretty soft over the past couple of weeks, the concern was, all right, maybe sentiment changes to your point, and maybe the activity and the willingness to spend on the consumer slows down. Do you see it on the investment landscape at all? Are your clients changing positions? Are they trying to be more defensive, or do they assume, look, this market only goes up?
I think clients are very reliant on us and our opinion and our advice in terms of what to do with their portfolios and asset allocation. With that said, I think most people are actually surprised how much their portfolios are up this year, because there's been a lot of negative news and going back and forth. And so I think investors are pleasantly surprised. I think 2020 sets up for a pretty interesting year. We could have some things line up in terms of what I viewed as the biggest obstacle to equity markets rising further, which was, the Fed. And now the Fed is a tailwind for us in terms of providing liquidity and lowering interest rates. So I think that we could get a trade deal. The Fed continues to be accommodative. If we get business confidence back and the consumer is strong, we could be set up for a pretty good 2020. And 2019, this year, I just hope that we finish kind of where we're at right now. I think that'd be good enough.
Jimmy, there's two parts of this I think that are really interesting to kind of take these elements and see how they work out together. Because on the one end, the idea that retail and the consumer activity has been robust, I think is reflected to some degree in the strength of stocks like Chipotle, Starbucks, McDonald's. People are finding these kind of regular, reliable places to trade over the last year, right? They've been a really robust trade, the kind of so-called consumer staples. But then on the flip side, to your point, last week, we get a good progress or something like it on the trade front, and then it's the value stocks that perform, and they're a little bit more cyclical. So what I'm trying to figure out is if the run for Starbucks and some of these companies, if this assumption of consumer activity has already been baked in. I mean, is their glory day of the last year over for Starbucks, McDonald's, and these?
I don't think it is. I think we could get some business confidence back and investing back into the cyclical names. But I think the opportunity for value stocks to potentially lead growth stocks might finally be here. Now, it might be too soon to call, but we're using sort of a barbell approach at our firm. We're still overweight in technology, and we think that technology will still perform well. But we've been over allocated as well in defensive sectors such as utilities and now financials. And so we'll see what happens this week with earnings week. A lot of big banks are going to be providing earnings reports. But I think the consumer, again, is still strong. And I think the consumer is what's holding up the economy today. And I don't think those in terms of setting new highs.
Yeah. Jimmy, last point, as we go into earnings season, we're going to talk about some specific stocks here in a sec with our next guest, but from the big picture, you mentioned technology. This is an area where now we're expecting declining earnings on an annual basis. Is this going to still be the same backbone from a fundamental standpoint?
Well, what's interesting is this, is that while year to date, the stock market's up almost 20% and closing in on highs again, if you look back over 12 months, the S&P 500 is up less than 5%. And there are a lot of sectors that are actually negative. And so it really depends on where you've been investing, if you've made money over the last 12 months or not. I think in terms of technology, though, technology is something that requires a global economy to expand. And a lot of the technology names, the big cap names, are global companies. And so hopefully what we'll see is a trade deal provide some confidence back into businesses, not just here in the U.S., but around the world. And we start to see growth, not just here in the U.S., but around the world, and start to recover. I'm a little bit worried about Brexit and what happens there, but I think that in the long run, that's going to end up being okay. It might be a little bit of a blip for the U.K., but when it comes to sectors like technology, I think investors should be thinking about the long term and make sure they've got a good allocation to the right names there.
Yeah. All right. Jimmy, always good catching up, talking some macro with you. Appreciate it. Jimmy Lee is the founder and CEO of the Wealth Consulting Group.